should you wait to have a bigger deposit rather than pay for LMI? Hi, my name is Rasti, and I thought of recording this a short video on LMI, which is commonly called as lender's mortgage insurance. I was just traveling through from Queenstown to Christchurch and thought of stopping at this beautiful landscape here, very close to the town called Omorama, and I'm here at Clay Cliff area. Now this is more of 18,000 years of erosion work that we are seeing here. Erosion done by wind and water. Now coming back to the question, why you should really think about paying for LMI, which is typically costing about 2 to 3% depending on the deposit level you're putting in and also depending on the bank we are talking about. Certainly this LMI, which is lender's mortgage insurance, is more for the insurance for the lender. Now you might be wondering, how come you are the one putting that money from your own pocket for the lender's insurance? Now the key thing to understand is that commonly or typically banks expect for the buyer or the investor to put a 20% deposit. If you choose to pay or put a lower deposit, let's say 10% deposit, then banks really want the insurance that in case the property market crashes or the market really goes down, then they really need to be insured against any losses that they might see in this transaction. And for that reason, they really expect the LMI or the insurance to be purchased at the cost of the investor or the buyer. Now, for someone who has a bigger deposit, even say for example 20-25%, I would argue that it makes sense for the investor or buyer to put a lower deposit, buy the insurance, LMI, so that it gives or leaves a bigger cash buffer in your pocket for the rainy day. So yes, it is insurance required by definition by the lender, but it's also a cash buffer or insurance for the investor like yourself, just to have that money for the rainy day. Let's also look at the thematic that why it makes sense to go for LMI or how the savvy property investors are using it as their tool to acquire multiple properties one after the other. So first of all, the amount or the outlay of the money that is required when LMI is considered, that's typically about say 17-18% rather than 25% of the purchase price. So let's talk about some examples. If the property is about $500,000, and if we have chosen to go for 10% deposit, that means about $50,000, rather than 20% deposit, which is about $100,000, we are really safeguarding or saving $50,000 outlay upfront. And of course, we have to pay about 2 or 3% of LMI. So effectively, it is leaving the investor about $40,000 extra in the pocket, everything being equal in those two scenarios. Now, this $40,000 can go a long way, primarily from the strategic point of view. In a typical scenario, when you are really thinking about putting 20% deposit and the holding cost, you really want to keep it very low, that means the tilt that you're going for is more of a balanced approach for your property. Whereas when you have that extra $40,000 in your pocket, which is serving as a buffer, you might choose to go for a capital growth oriented property because you have that extra money in your pocket to have the cash flow, negative cash flow from your pocket. So as you can see from this example, that not only it is really safeguarding you from any rainy day scenario, but it also allowing you to buy the property sooner. And the argument that goes in favor of putting less deposit is that in general, we have seen the property market growing at about 5 or 6%. And if it allows you to buy a property maybe 6 months sooner, you have already recouped the cost of the LMI. Also, if it is for investment property, this is a tax deductible cost, which your accountant can really expense it out for that LMI cost over 5 years or so. If you really enjoyed this video, like this video, share or comment, or if you have any further questions, please free to put in the comments below. Talk to you soon. Cheers, thanks, bye.